In the FinTech ecosystem, one of the most important structural distinctions lies between platform-based intermediation models and capital-backed balance sheet models. An asset-light platform does not primarily use its own capital to originate and hold financial exposures. Instead, it acts as a digital intermediary that connects borrowers, investors, payment participants, or merchants through technology infrastructure. The platform earns through facilitation fees, commissions, or revenue sharing, while credit, liquidity, or market risk is contractually transferred to third parties such as partner banks, institutional investors, or peer participants. A practical illustration is the Indian digital lending marketplace operated by Paisabazaar under the PB FinTech Group. The company aggregates loan products from multiple banks and non-banking financial companies, but does not fund the loans from its own balance sheet. Credit losses, capital provisioning, and regulatory capital requirements remain with the regulated lending institutions. The platform's core risk is operational, technological, reputational, and compliance-related, rather than direct credit absorption. Structurally, this creates a risk-light architecture, but increases dependency on partner resilience. In contrast, capital-backed models such as traditional banks or non-banking financial companies originate assets using their own balance sheets. When a bank sanctions a loan, the exposure sits directly on its books, and the institution absorbs credit risk if the borrower defaults. This structure requires regulatory capital buffers, liquidity coverage ratios, provisioning norms, and continuous supervisory reporting. The institution must maintain minimum capital adequacy ratios to absorb unexpected losses and protect depositors or investors. Consider HDFC Bank's retail lending operations in India. When the bank extends a housing loan, it must allocate capital under regulatory norms prescribed by the Reserve Bank of India. If macroeconomic stress increases default rates, the bank's profitability and capital adequacy are directly impacted. Unlike a platform, the bank cannot simply transfer losses unless securitization or risk participation structures are formally executed. Therefore, risk absorption is internal and capital intensive. The structural DNA embeds prudential oversight deeply into the operating model, making regulatory visibility significantly higher compared to asset-light platforms. The structural DNA difference ultimately lies in who absorbs financial shocks and how regulators perceive systemic exposure. In platform intermediation, risk is distributed across multiple regulated entities, often creating fragmented regulatory visibility. The platform may fall under technology or intermediary guidelines, while underlying credit risk sits elsewhere. This can create supervisory blind spots if risk concentration builds indirectly through partner institutions. A relevant real-world example emerged during regulatory reviews of digital lending ecosystems in India in 2022. Authorities observed that while many digital platforms did not carry loans on their balance sheets, their sourcing practices significantly influenced credit quality at partner non-banking financial companies. The economic risk originated through platform-driven underwriting algorithms, yet capital buffers were maintained only by the lending entities. This highlights how platforms shape risk without absorbing it. In contrast, balance sheet institutions internalize both decision authority and capital consequences, ensuring clearer alignment between risk creation and risk absorption within the regulatory perimeter.